job's a joke, you broke, your love life's the away. It's like you're always stuck in second gear, when it hasn't been your day, your week, your month, or even your year. But I'll be there for you when the rain starts to fall. I'll be there for you like I've been there before. I'll be there for you 'cause you're there for me too.
What is capital structure? Capital structure refers to the process through which a business uses a variety of funding sources such as debt and equity to finance its operation and expansions. It shows how a firm has financed its assets and operation in terms of debt and equity. In simple terms, capital structure is the use of a combination of long-term debt, short-term debt, and equity to finance its total operations. With debt financing, money is borrowed from creditors like banks or bondholders, but with equity, financing money is raised by selling investors' shares of the firm. The capital structure decision is crucial for a company as it affects its risk profile, cost of capital, and financial stability. A company with a higher proportion of debt in its capital structure is considered more leveraged and may have higher financial risk. On the other hand, a company with a higher proportion of equity may have a lower financial risk but might face higher cost of capital. Next is how to determine optimal capital structure. Firstly is by calculate the cost of capital. It measures the cost of debt and equity of the firm, and the interest rate a company pays on its debt is known as the cost of debt, while the return that shareholders expect from a corporation is known as the cost of equity. This cost represents the risk connected to each financing option, and to determine the total cost of capital, use suitable financial models such as the weighted average cost of capital (WACC). The next method is by analyze the trade-off between debt and equity. That may enhance leverage and provide tax advantages, but it also raises financial risk and interest costs. Although it decreases financial risk and gives flexibility, equity financing dilutes ownership. It is important to analyze the effects of various capital structures on the risk profile, financial flexibility, and potential for future growth of the company.
Now, I will explain about factors that affect capital structure and capital structure decisions. They are both internal and external elements that might have impact on a company capital structure. The cost of capital is the first internal component to consider. For the process of capital formulation to be useful, the capital used must provide sufficient return to cover the cost of capital. This is shifting for two main reasons, which interest rates are now lower than dividend rates, and interest payment on borrowed capital are deductible. Second, financial risk is when a company can't pay its set costs like interest, dividends, payments to supplier, and etc. A business faces money risk in addition to financial risk. It depends on the cost of doing business. If the cost of doing business is high, the business risk is high. The total risk depends on both the business risk and the cash risk. The third consideration is the controlling factor. Private companies have accounted for this aspect in their capital raising and strategic planning processes. The issuing of equity and preference shares is intended to be a long-term source of funding for the firm. It is irrelevant to the borrowed funds. However, the first external factors are tax policy. Tax rules can change the stock price of a business structure. If a company can get tax deduction for loan capital, it may be more likely to use it. Additionally, competition has the potential to influence the capital structure of a company. If a firm rivals have a high level of leverage, the company may feel pressure to raise its own leverage to maintain its competitive advantage. Lastly, the capital framework of a company can be affected by the state of the capital markets. If financing rates are low, a business may be able to receive more money at a lower cost. If the market is in a downturn, equity-based capital is preferred because it has less risk. Now, I will explain about financial distress. In the state of financial distress, a company or person has insufficient financing to meet its financial commitments. Reasons for bankruptcy include excessive fixed expenditures, outdated equipment, excessive debt, poor financial planning and management. When a business can't pay its suppliers and loan, it's in financial trouble. This is more likely to happen when a company has a lot of debt, its profit per unit is low, its break-even point is high, or its sales are sensitive to drops in the company. A company might experience financial trouble if it incurs expenses in addition to the normal operating costs of the company. Furthermore, it can be either direct or indirect. Legal expenditures such as those for licensing, registration, and administration are also included in this category of direct costs. In contrast, indirect costs may include things like those incurred due to the loss of prospective clients, vendors, liquidation delays, and etc. The corporation may decide to sell its asset to solve its cash flow problems. However, once a business arrives at the point of financial distress, its expenses may affect the worth of that company, leading to a decrease in market value.
Now we're moving on to integration of tax effects and financial distress costs. Tax effects and financial distress costs are two important considerations in corporate finance. Tax effects refers to the impact that taxes have on companies' financial performance and decision making. Taxes can affect a company's cash flows, profitability, and overall financial health. Financial distress costs, on the other hand, refer to the costs associated with the potential of bankruptcy of a firm, which can also have a significant impact on financial decision making. One way to integrate tax effects and financial distress costs is through the use of models such as the trade-off theory or capital structure. This theory suggests that there is an optimal level of debt for a company where the tax benefits of debt are balanced against financial distress costs. Incorporating tax effects and financial distress costs into financial decision making can help companies make more informed decisions about their capital structures, investments, and dividend policy. For example, a company may choose to issue debt to take advantage of tax benefits, but must also consider the potential financial distress costs associated with a high level of debt. Now, let's move on to adjusted cost of equity. Adjusted cost of equity refers to the cost incurred by a firm when its managers do not act in the best interest of the shareholders. When managers prioritize their own interests over those of the shareholders, it creates a conflict interest situation that can negatively affect the company. Let's just say it involves the reputation of the company itself.
Next, I will explain about the pecking order theory. The pecking order theory has been developed as an alternative traditional theory. This theory is based on the view that companies will not seek to minimize their weighted average cost of capital or WACC. Instead, they will seek additional finance in an order of preference. So, the order of preference will be retained earnings first as the internal financing and then external financing, which debt and equity. So, if there is a new project in the company, they tend to finance it with retained earnings first. If they still need money, then they will use debt. And if they still need money, then they will use equity as the last options. The reason why the company do follow the pecking order is because cost of internal financing is lower than external financing due to asymmetric informations. So, what is asymmetric information? Well, asymmetric information is information failure. It occurs when one party possesses more than the other party, which causes an imbalance in transaction power. This is because managers know the company better while creditor and investor not. Therefore, cost of debt and equity, which are external financing, is higher than the cost of internal financings. For example, in the company, of course, company manager is the one who know the company performance, company risk, and also company prospect clearly, right? While creditor and investor, they do not know completely about the company performance, company prospect, and also company risk. Therefore, creditor and investor demand higher costs because they don't know precisely actually the prospect of the company. That makes external financing has costs higher than internal financings. Moreover, as what I have discussed earlier, that cost of debt is usually lower than cost of equity. So, by considering the cost, the company prefer to use retained earnings first, then debt, and then lastly equity. This is what we mentioned by pecking order theory. Now, moving on to the signaling hypothesis, where when both manager and stockholder have the same information, this is referred to as signaling theory or also called as systematic informations. In practice, managers are more knowledgeable than shareholder or investor, which we call as asymmetric informations. The capital structure of the firm is optimized so that the marginal subsidy to debt match the marginal cost.
For the conclusion, every organization continues to depend on its capital structure to generate value because without financing, it cannot carry out its strategic management plans. The management at every organization should be concerned with focusing on the infrastructure of the company's capital structure.